From the Trading Nation, I'm Mike Santoli. Stocks rallying on Monday after the U.S. made a new North American trade deal. Joining us with his market analysis, Art Hogan, B. Riley FBR Chief Market Strategist. Art, good to see you. The market seemed like it was pretty much tilted to the upside anyway, shall we say, to start the fourth quarter. A lot of, kind of good things going on with this uptrend. How does today's trade news filter into your outlook for the market, though?
Yeah, Mike, that's a great question because the seasonality coming into the fourth quarter was going to be good. It's a midterm election. October's and midterm elections tend to be good. The fourth quarter midterm election cycles tend to be good. One of the biggest headwinds, I think, and that's been the case for most of this year, has been trade, the uncertainty around trade. And the biggest piece of moving forward with that was getting North America right. Spent 13 months trying to get that accomplished, but it seemed like it should have been the easiest piece. Getting that behind us, and apparently we have, is going to make everything else a bit easier, or at least something, something we can accomplish. So without North America, we weren't going to be able to sit down at the negotiating table with China and accomplish something next year. I think this alleviates a lot of the pressure we had. And even going into last week, the end of last week, it sounded like things were escalating with Canada, not getting better. So I think this is real good news. Get North America right. Don't escalate with the Eurozone. You have a better chance in 19 to get something done with China.
I guess the big question, Art, if you do think that trade remains this overhang, is just exactly how applicable the experience with Canada and Mexico is to China. As you said, this was supposed to be the easy one. So do you think that the market right now is pricing in potential progress in negotiations with China, or is that going to be kind of a bonus down the road?
No, it'd be a major bonus if we can get something accomplished. Unfortunately, that's going to get worse before it gets better. So if you look at the drag right now of everything we've put forward with China, it's about $35 billion juxtaposed against about a $17 trillion economy. So it doesn't appear to be that large, but things can get worse, and they get a whole lot worse. If we go the whole Megillah and put some sort of tax on everything that we import from China, that gets to be about $140 billion. Still not big compared to the size of the economy, but it doesn't stop there. It's the complicated and very complex supply chains. It's the other things China can do to retaliate. So if you have a long, drawn-out, mutually destructive trade war with China, which nobody wants and nobody's pricing in, that's going to be a significant drag on the economy. More of a drag than fiscal policy is stimulating the economy.
I guess you mentioned that, we obviously have some favorable seasonal forces kicking in. Now, the weak seasonality of August and September didn't play out, which is certainly to the benefit of investors right now. But do you think that we're going to be in for any more choppiness this quarter? Or do you feel like, people are just going to say we can ride this market higher into year end?
I think we're going to have two flavors of news coming out, in the fourth quarter and certainly over the next month or so. One flavor is going to be what, that sort of chorus of noise coming out of Washington, whether it has to do with Russia investigations or the midterm elections and how that's polling. And the other piece is going to be about the third quarter earnings reporting season and the economic data. And I think you really want to try to ignore the former and pay attention to the latter because it's much more important to this market. So I think that any cause for choppiness is going to be things getting worse with trade talks in China. I think that any constructive move towards at least sitting down and having a conversation with China, working out the details of what it is that we want. It's hard to know what we're looking for, but getting closer to that, and I truly believe that's business for next year is going to help. But I think the seasonality and the strong earnings that we continue to see in the third quarter and probably in the fourth quarter are going to help. What's going to be very interesting to me, though, is third quarter earnings reporting season starts in a couple of weeks. Our CEO is going to finally come to the table and say, I'm concerned about what tariffs mean to my business, and here's where I can see the drag. Fred Smith at FedEx is probably the only CEO that's really addressed this in a conference call. I'd be curious to see if that's the new, strong dollar in the conference call that we heard the second quarter. This is the drag. This is why I'm going to be, a bit more guarded about my guidance going forward.
Sure. And looking beyond that, it's always hard to kind of peer out 15 months. But 2019, the market is going to be most likely sitting on some gains as the economy and earnings growth decelerate, but still look pretty good. So what do you think the market can deliver for 2019?
I'd be thrilled to see a sort of high single-digit, low double-digit return for the S&P 500. What could keep that from happening is either this trade war drags out and gets much uglier than what we're envisioning right now, or something happens away from us. So Italy just dropped their budget, and if Brussels looks at that and says, hey, this is nowhere close to what we approve of in the Eurozone, and there's pushback, and then Italy turns into the next Brexit, and you get a slow unwind and more dissent by some of the members of the European Union, I think that could be a problem. I think that the Fed starting to sound like they're going to push beyond neutral in 19. So if they stick to their dot plots and go in December and 3 more times in 19. That pushes them beyond neutral. At the same time, they're unwinding the balance sheet. So it could be a Fed policy mistake that derails this. But if everything were to line up the way we know it to be now, we have sort of 10% earnings growth on 7% revenue growth next year, kind of a normalized year. An 8% return on the S&P 500 with a 1.5% dividend gets you close to a 10% total return, and not a bad year at all.
No, it wouldn't be for sure, especially coming after 2 pretty good ones, most likely. Art Hogan, B. Riley FBR, thanks very much for joining us today. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.